We're jumping straight into AeroVironment today. Everyone is watching the price action, but the real story is the extreme volatility driven by a massive surge in defense demand, crashing right into a major contract rebid.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Subscribe and hit the like button.
Right, so.
Because we really need to unpack what happened on March 2nd, specifically March 2nd, 2026.
Yeah.
Because if you were watching the tape that day, it was just, it was an absolute roller coaster. We saw this incredibly violent, classic pop and drop.
Like textbook pop and drop.
Right. For the stock just surges, right? 20%, straight out of the gate. And this was entirely fueled by geopolitical news.
The headlines.
Yeah, the escalating tensions and all the headlines regarding the Iran conflict.
Yeah.
The market sees that, and they immediately pour money into defense tech. But then,
Could reverse it.
almost instantly, the bottom completely fell out. We were talking about a staggering 17 to 20% plunge right after that peak, violently landing in that $208 to $222 range.
It was whiplash. Literally whiplash in real time. And to really understand the severity of that move, you have to look at the trading volume. Because usually, this stock trades maybe 1.4 million shares a day.
Right.
But on this day, March 2nd, an eye-watering 13.3 million shares changed hands.
Which just...
It's sheer panic colliding with intense excitement. That's 13.3 million.
It honestly felt like stepping off a curb you didn't know was there. One minute you're riding this massive geopolitical high, and the next, your stomach just completely drops out.
That's the perfect way to describe it. Because when you see volume that aggressively high, especially on a downward swing after a sudden pop, it's what we call a textbook capitulation event.
Right, exhaustion selling. Exactly, exhaustion selling. The momentum traders, the guys who jumped in on the headline, they panicked at the first sign of red and immediately liquidated, just locking in losses. But historically, this kind of extreme sell-off, it actually clears the deck.
It flushes out the weak hand.
It flushes out the speculative money, right? And it can actually set up a basing period, a foundation for a reversal back upward once all that emotional trading subsides and the dust actually settles.
So it's basically like a colossal pressure valve just blew off. And now the broader market has to sit down, do the math, and figure out what the company is actually fundamentally worth.
Exactly.
Which, it leads me to wonder, why were investors piling in so aggressively in the first place, right before that massive drop? Like, what is the underlying story driving that initial excitement?
Well, if we pull back, if we look at the bigger picture, the fundamentals underneath that daily volatility are genuinely unprecedented.
Yeah.
We are looking at a company that just reported quarterly revenue of $472.5 million.
That is a 150.7% year-over-year increase. You simply do not see traditional defense companies doubling their top line and then some in a single year.
150%. That is hyper-growth tech company territory. That is not your grandpa's defense contractor slowly churning out submarines for the Navy.
Not at all.
And the reason why this is happening, it's a sweeping global paradigm shift in how militaries operate. We're witnessing a fundamental change in warfare.
Yeah.
There is this urgent worldwide demand for unmanned systems right now. Militaries are aggressively moving away from putting boots on the ground or, flying multi-million-dollar jets into highly contested airspace.
It's too risky.
Right. And they're pivoting towards smart, scalable drone technology.
And this company isn't just participating in that shift. They are actively defining it.
They are.
They've built this very specific, incredibly hard-to-replicate competitive moat. We are talking about highly proprietary products that create massive switching costs for the Department of Defense.
Yeah, specifically their Switchblade loitering munitions and their Puma reconnaissance drones.
Right.
And for anyone unfamiliar with the terminology, loitering munition isn't a traditional missile. It is basically a smart drone that you launch and you have it hang out in the sky.
Literally loitering.
Literally loitering. It uses advanced optics to identify a target and then acts as a precision strike weapon.
And these aren't just, concepts sitting on a drawing board in some R&D lab. They have proven real-world deployment in major operations.
Exactly. Let's look at Operation Epic Fury. In the past, if a platoon was pinned down by enemy fire over a ridge, you'd have to call in an airstrike.
You're waiting for an F-35.
Right, an F-35 or an Apache helicopter. You were risking a pilot and an incredibly expensive piece of hardware. But in Epic Fury, soldiers were literally unrolling a tube from a backpack, launching a Switchblade, using the camera to find the exact threat over the ridge, and neutralizing it in minutes.
It's a completely different game.
It fundamentally changes the math of engagement on the battlefield.
It changes the battlefield math, but crucially for investors, it changes the procurement cycle.
Oh, absolutely.
Because once the U.S. military trains its personnel on the Switchblade ecosystem, and they integrate that specific hardware into their proprietary battlefield software.
And build their doctrine around it.
Exactly.
Yeah.
Once the tactical doctrine is built around it, they do not want to start over with a new vendor. That operational friction is a monumental advantage.
It's the ultimate lock-in.
It really is. But what makes that moat even deeper is their 2025 acquisition of BlueHalo.
Yes, BlueHalo.
This is a strategic masterstroke that I honestly think a lot of retail investors are still underestimating. Because BlueHalo essentially gives them a serious edge in space capabilities and crucially AI-driven mission systems.
Let's expand on that AI piece, because throwing the word AI around is a bit of a cliche right now. Everyone says they have AI. What does that practically look like on the battlefield for them?
It's a total game changer. With BlueHalo's software, you are moving from a one-pilot, one-drone model to a swarm logic model.
Swarm logic.
Right. BlueHalo allows a single operator to command an entire swarm of drones simultaneously using AI. The artificial intelligence offloads the cognitive burden from the pilot.
So the human isn't flying the drone.
Exactly.
Yeah.
The AI handles the flight paths, the collision avoidance, the target identification across 50 different drones at once, and the human operator just sits back and focuses on the final strategic decisions.
Wow.
So by bringing BlueHalo in-house, they shifted the math from one pilot, one plane to one pilot, 50 drones.
That is wild to think about. Just one guy with an iPad running 50 drones.
And it instantly protected them against aggressive competitors like Kratos. They aren't just selling individual hardware anymore. They're selling a fully integrated AI-powered defense network.
And doing that requires massive capital, which is why I was looking at their balance sheet, and their liquidity ratios seem unusually high for companies spending this much on autonomous R&D.
They are.
How secure is their war chest to actually pull off this whole AI swarm vision?
It is incredibly secure. Just to contextualize the balance sheet for a second, they are sitting on a quick ratio of 4.29 and a current ratio of 5.08.
Right.
Plus, they have a tiny debt-to-equity ratio of just 0.16.
So break those ratios down for the listener who doesn't stare at balance sheets all day. What does a current ratio of 5.08 actually mean in plain English?
Okay, think of it like this. For every single dollar this company owes and have to pay back tomorrow, they have roughly $5 in cash and highly liquid assets just sitting in the bank ready to go.
5 to 1.
5 to 1. That kind of liquidity is a financial fortress. In a macroeconomic environment where other companies are stressing about high interest rates or, struggling to refinance debt, they have the absolute freedom to invest aggressively.
And they are definitely going to need that cash.
Yeah.
Because they are sitting on a staggering $2.8 billion backlog of orders.
Yep.
$2.8 billion. That is guaranteed future cash flow just waiting to be realized. And what I find really fascinating is their capital allocation strategy.
The reinvestment.
Yeah. Instead of doing what a lot of legacy defense companies do, where they take that cash and just do stock buybacks to artificially pump up the share price for a quarter, they're taking those funds and reinvesting them heavily into autonomous R&D.
They are playing a very long game.
A very long game.
Which is exactly why major financial institutions have highly positive outlooks on the stock right now.
Mm-hmm.
If you look at Wall Street's expectations, you have a consensus target hovering around $367.
Okay.
And there are some very prominent institutional targets pointing even higher, ranging from $390 all the way up to $429.
That's significant upside.
It is. The institutional analysts see the 150th revenue growth. They understand the AI synergies of that BlueHalo integration, and they see that $2.8 billion backlog as a massive safety net.
Okay, I hear you on the cash flow and those high targets, but looking at the flip side,
Sure.
I have to play devil's advocate here. A backlog doesn't mean anything if you can't actually execute on the margins.
Right.
And we can't ignore the elephant in the room. This company missed earnings, and they are facing a severe threat to their revenue stream.
You're absolutely right to push back on this, because it's not all blue skies. There is a very real $1.4 billion threat hanging over them right now.
Right.
And it's the primary reason for the anxiety we saw in that stock drop. The Space Force is currently rebidding the SR contract.
Let's define that for the listener, because SCAR is one of those classic defense acronyms that just gets thrown around in press releases without any explanation. SCAR stands for Satellite Communications Augmentation Resource.
Correct. And as we move toward a military that relies entirely on drones and AI swarms, the communication links...
Between the drones and the operator?
Exactly. The links between the drones, the ground operators, and the satellites in space. That becomes the most critical vulnerability on the battlefield.
Because if they jam you, you're done?
If an adversary jams those communications, your entire drone swarm is completely useless. So the SCAR contract is the Space Force's sweeping initiative to upgrade, secure, and really expand the bandwidth of those critical satellite control networks.
So if they lose this rebid to their competitors, the fallout wouldn't just be a lost revenue stream from the Space Force.
No.
It could trigger severe margin compression across their entire portfolio. And worse, it would seriously damage the premium valuation they fought so hard to justify from that Blue Halo acquisition. A huge part of the Blue Halo thesis relies on winning and expanding contracts, exactly like SCAR.
Exactly. The hardware is impressive, sure. But the connective tissue, the satellite communications, is where the high-margin recurring revenue lives.
Right.
Which brings us to their current financial reality. Because despite that jaw-dropping 150% revenue growth we just talked about, their recent earnings actually missed the mark.
They did.
They reported 44 cents in earnings per share when the street was expecting 87 cents.
That's a huge miss. And their profit margins are feeling the squeeze. Right now, they're sitting at a net margin of negative 5.08%. Plus, they are trading at a highly expensive price-to-earnings ratio of negative 182.63.
Which sounds terrifying to a lot of people.
Right. For anyone wondering what a negative PE practically implies for a growth stock like this, it means they are aggressively spending every single dime they make, and then some, on capturing market share and pushing R&D. They are prioritizing top-line expansion and technological dominance over current profitability.
Yeah.
Think of it like Amazon in its early days. They are in the land grab phase of defense tech.
But that land grab phase makes traditional defense investors very nervous. You have a company growing the top line like crazy, but the bottom line is currently bleeding.
Bleeding heavily.
So when you combine negative profit margins with a $1.4 billion contract suddenly up in the air, the market's anxiety is entirely justified.
And when institutional investors get anxious, they start looking for any signal from the people inside the building. Which brings me to the insider selling.
Oh, yes.
Specifically, the chief financial officer sold 999 shares in January 2026. On the surface, the CFO selling shares right before a period of extreme volatility sounds like a glaring red flag.
It sounds like one. But we have to elevate our analysis here. You have to look at the mechanics of that specific trade. 999 shares at these price levels is roughly $200,000.
Right.
In the corporate finance world, a specific odd lot number like that right at the start of the calendar year is almost certainly a scheduled 10b5-1 tax withholding sale.
Okay.
It is an automated transaction to cover the tax obligations on vested stock options. It is not a discretionary dump because the CFO thinks the ship is sinking.
That makes a lot of sense. So it's an administrative move, not a panic button.
Precisely. It's a puzzle piece, but not a panic button. And what is far more telling than one executive's tax bill is the broader institutional flow.
The big...
Exactly. Institutional buying the big funds and asset managers actually outweighs selling 2-to-1 over the last year. So while the retail market might be panicking over a temporary drop, the smart money at large is still heavily accumulating shares.
Okay, so with all these competing narratives, you've got hypergrowth versus negative margins, massive backlogs versus contract rebids. So what should you be watching right now? Because with this kind of extreme volatility, sitting on the sidelines without a roadmap is a guaranteed way to get caught off guard.
The absolute most critical date on the immediate horizon is March 10th.
March 10th.
That is when their Q3 fiscal year 2026 results come out, with the conference call scheduled for 4.3 Euro Eastern. The expectations right now are hovering around 73 cents in adjusted earnings per share.
Right.
If they can hit that number, it could represent roughly 100% year-over-year growth for the quarter.
But honestly, the earnings per share for this specific quarter is only half the story. The real make-or-break moment on that call is going to be their forward guidance. They have previously guided for fiscal year 2026 earnings per share to land between $3.40 and $3.55.
Yes.
They absolutely have to defend that forecast.
Hitting or reaffirming that 3.40 to 3.55 guidance is the ultimate proof of concept for this entire enterprise.
It proves the model.
It would signal to the market that the sustained growth is real, that the margin pressures are just temporary growing pains, and most importantly, it would prove that the highly expensive Blue Halo integration is actually working and generating the synergies they promised.
And beyond the earnings call, there are a couple of other major catalysts you need to keep on your radar over the next 30 days. First, keep an eye on the Citizens JMP conference.
Oh, definitely.
The executive team is going to be presenting there, and we expect some serious strategic growth updates.
Yeah.
Management frequently uses these specific investor conferences to aggressively control the narrative, especially after a volatile stock drop.
And second, keep your ear to the ground for literally any news regarding that Space Force SCAR contract rebid. Specifically, you want to listen for any updates involving their proven Badger units.
Let's clarify what a Badger unit is for the audience. Badger refers to their highly deployable, resilient ground terminal systems.
The physical hardware.
Right. These are the physical, multi-band antenna units on the ground that link directly into the SCAR network. They're designed to be mobile, rapidly deployed, and highly resistant to jamming.
Exactly. They are a critical piece of hardware. If the company can successfully leverage the proven track record and reliability of those Badger units to defend that $1.4 billion SCAR contract, the relief rally in the stock could be substantial.
It would be massive.
It would immediately remove the biggest dark cloud hanging over their valuation.
And we can't forget the broader macro landscape because this company does not exist in a vacuum. You have to monitor the geopolitical flows. The escalating tensions involving Iran, coupled with ongoing U.S. and Israel operations in the Middle East, that is creating a macro environment that practically mandates surges in defense spending.
And we aren't just seeing broad, untargeted defense buying. We are seeing a very specific sector rotation out of legacy platforms and into drone and autonomous technology.
The shift is happening now.
Even if they stumble on a specific contract like SCAR, the geopolitical tailwinds pushing their specific sector forward are incredibly strong right now. Every major military in the world is watching these conflicts and realizing they need thousands of smart drones, not dozens of fighter jets.
It's a fascinating setup. You have all the macro winds blowing entirely in their favor, but they have to flawlessly execute the micro details of these specific, highly contested government contracts.
If we synthesize all of this, you are looking at a masterclass in risk versus reward. On one hand, you have a 150% revenue growth machine, fortified by a $2.8 billion backlog, a pristine balance sheet, and a transformative AI acquisition.
The bull case is strong.
But on the other hand, management is performing a high-wire act, trying to secure a $1.4 billion contract rebid while navigating negative profit margins and the extreme market volatility that comes with a negative PE ratio.
That's a lot to balance.
It is. It really leaves you with a profound question to ponder as we watch this play out over the next few quarters. If modern warfare is permanently shifting toward AI-driven autonomous drones, how will traditional defense contractors adapt to the kind of extreme tech company-like stock volatility we're seeing with AeroVironment?
Right, because we are used to defense stocks being slow, steady dividend pairs. Now they're trading like Silicon Valley startups.
It completely changes the risk profile for investors who thought they were buying a safe, boring defense stock. The defense sector is becoming the tech sector, and with that comes tech sector volatility.
That's the lowdown on AeroVironment. Make sure you mark March 10th on your calendar, keep an eye on those contract catalysts, and stay tuned to the market. We'll catch you next time.